Early 2026 was an incredibly nervous time for the global economy. In late February, conflict in the Middle East escalated, pushing up global energy prices. Supply chains were rattling, and much of the world was bracing for a serious economic slowdown. But then, Singapore released its official economic data for the first quarter, and the numbers caught almost everyone off guard. Singapore's real GDP, which measures the inflation-adjusted value of the economy's final goods and services, grew by a massive 6.0% compared to the exact same time last year. To see why this was such a shock, you have to look at the timeline. When the government released its early advance estimate, the picture looked soft. That initial estimate still showed year-on-year growth at 4.6%, but it suggested the economy had actually shrunk by 0.3% compared with the previous quarter. But when the final data came out, it completely flipped the narrative. Quarter on quarter, the economy had actually expanded by 1.0%. So, how did Singapore accelerate while the rest of the world was bracing for an energy shock? The answer is not that Singapore was magically immune to global headwinds. It's that Singapore was unusually well positioned to capture the one massive tailwind that was still blowing: artificial intelligence. Since 2024, the global build-out of AI infrastructure has created a relentless demand for hardware. In the first quarter, Singapore's manufacturing sector grew by 7.9%. But if you look inside that number, the electronics cluster skyrocketed by an incredible 26.1%. Precision engineering, which supports this tech, also grew by 8.9%. In simpler terms, the world desperately needed the physical hardware that makes AI work. Things like memory chips, semiconductors, servers, and server-related products. And Singapore's electronics base was perfectly positioned to supply them. But making these chips is only the first half of the equation. The second half is actually moving them around the world. This is where Singapore's unique role as a global hub completely changes the math. Think of Singapore as a giant global sorting facility. They don't just build electronics, they broker, finance, and ship them across the globe. Because of this, wholesale trade was actually the single largest contributor to Singapore's overall GDP growth, expanding by 11.7%. And if you want proof, just look at the export numbers. They are staggering. Overall merchandise exports rose by 27.9%. Non-oil domestic exports grew by 9.6%, driven by a massive 57.8% surge in electronics exports. And re-exports, which are goods that simply pass through Singapore's hub to be sold to other countries, jumped by 45.6%. Singapore's resilience was not just about factory production. It was about capturing a major share of the AI-linked trade flow moving through Asia. And this was not just a temporary spike in sales. International companies were putting permanent roots in the ground. In the first quarter of 2026, the Economic Development Board recorded 2.4 billion Singapore dollars in fixed asset investment commitments. Out of that total, the electronics cluster alone accounted for 2.153 billion Singapore dollars. That tells us that investors and companies are making long-term capital commitments to Singapore's tech base. If you look at the country's external accounts, the numbers are huge. Singapore recorded a 16.9 billion Singapore dollar balance of payments surplus and a 41.1 billion Singapore dollar current account surplus. This essentially means Singapore earned far more from its external transactions than it paid out to the rest of the world. Overall, Singapore was still recording strong external surpluses and positive direct investment inflows, which hit 15.9 billion Singapore dollars, even as fast-moving portfolio money moved outward, driving a $26.0 billion net outflow in the capital and financial account. While all of this was happening with physical hardware, Singapore's financial sector found growth from a completely different, almost opposite source: global volatility. When the Middle East conflict escalated, global uncertainty spiked. Normally, uncertainty can hurt an economy, but for a global financial center, volatility means movement. Investors have to rapidly hedge their risks and reallocate their portfolios to protect their money. Because of all this active trading, banking, and fund management, Singapore's finance and insurance sector grew by 5.7%, collecting steady net fees and commissions along the way. But here's the reality of running a country. An economy can't survive on international tech and finance alone. It needs a local safety net. Singapore had that buffer in its construction sector, which grew by 11.8%. This was driven by a rise in certified progress payments, with public sector payments up 21.8% and private sector payments up 16.1%. But there's a catch here. While current construction output was strong, new contracts awarded actually fell by 24.9%. This means while construction acted as a strong buffer in the first quarter, it's not a guaranteed engine for the future. Meanwhile, the local economy stayed moving because of logistics and tourism. On the logistics side, sea cargo grew by 5.7% and air cargo rose by 5.5%. On the tourism side, the recovery held steady. Accommodation grew by 6.6%. Visitor arrivals rose by 2.8%, and hotel occupancy reached 83.1%. At this point, it sounds like Singapore had a perfect quarter. But to truly understand this economy, we have to look at what was failing. The chemical sector contracted by 6.1%. Biomedical manufacturing dropped sharply by 24.1%. Domestic wholesale trade sales volumes fell by 12.5%, and food and beverage services barely grew at all, at just 0.4%. This is incredibly important. The reality is that Singapore grew because its strongest sector simply outweighed its weakness in other industries. The massive gains in AI, exports, and finance were heavy enough to carry the sectors that were struggling. There's one final underlying reason why Singapore managed this volatile quarter so successfully: basic macro stability. When 2026 began, consumer prices were rising at a relatively low 1.5%. Unemployment was low, sitting safely at 2.9% for residents in March, and layoffs were stable. Furthermore, overall unit labor costs actually fell by 1.0%. In simple terms, worker productivity was growing faster than wages, which kept costs down for businesses. This baseline stability gave Singapore the breathing room to absorb the early impact of the Middle East energy shock without a sudden drop in business or consumer confidence. And when the risks of imported inflation began to rise after the quarter ended, the government and the central bank reacted quickly. In April, the Monetary Authority of Singapore tightened its monetary policy. Instead of changing interest rates like other countries do, Singapore manages the value of its currency. The central bank slightly increased the rate of appreciation of the Singapore dollar nominal effective exchange rate policy band. This allowed the local currency to strengthen, which helps lower the cost of imported goods and fights off inflation. At the same time, the government rolled out an enhanced support package. They brought forward 500 Singapore dollar CDC vouchers to help households with daily expenses. They increased the cost of living special payment to between 400 and 600 Singapore dollars. They introduced $200 in cash relief for eligible platform workers and drivers, and raised the corporate income tax rebate to 50%. These April policy actions didn't create the first quarter growth, since the quarter was already over, but they acted as a vital shield to protect households and businesses from the energy shock moving forward. When you put all of this together, it's easy to think Singapore was a lone economic miracle, but it wasn't. Other Asian economies connected to the AI industry also saw a major surge. Hong Kong grew by 5.9%, and China maintained a 5.0% growth rate despite weakening momentum. Taiwan's growth reached a staggering 14.55% because of powerful demand for AI and high-performance computing. Singapore didn't escape the global economic cycle. It was simply one of the economies best positioned to monetize the exact part of the global cycle that was still booming. But this unique strength also comes with serious risks. The government explicitly warned that the ongoing Middle East conflict could hurt the economy through supply chain disruptions and higher energy costs. The energy risk is especially serious because Singapore relies on imported natural gas for about 95% of its electricity generation, leaving it deeply exposed to global price shocks. There's also a very specific, quiet risk regarding manufacturing. The Middle East is a critical supplier of highly specialized materials like helium, bromine, and sulfur. These are essential components required to manufacture semiconductors. If access to those inputs is disrupted, Singapore's massive electronics cluster could face severe production constraints. So the final picture is straightforward. Singapore's economy held up beautifully in early 2026 because the exact sectors it specializes in were exactly what the world needed. But by relying so heavily on global trade, specialized hardware, and imported energy, country's main driver of growth is also the exact area where it remains most exposed to global changes.